What is a candle range theory? The candle range theory is usually presented as a three-candlestick pattern. The first candle forms a range, setting the high and low for the period. Second candle may attempt to manipulate this range by wicking beyond it, potentially creating a turtle soup scenario where a false breakout occurs. The third candle then either confirms the direction by breaking out of this range or re-enters it, potentially leading to further price action or consolidation. Every single candle represents a range as it has a high and a low. The high and low of a candle form a range within that specific time in the markets is indeed fractal, meaning that patterns repeat on various time frames. A daily candle is composed of 6 4-hour candles. A 4-hour candle goes to 4 1-hour candles, and so on. Give your scene on smaller time frames can be similar to that on larger time frames, just with more detail. Two types of CRT models can be formed. The first is a 3-candle pattern, and the second is a 3-candle pattern with an inside bar, as mentioned at the beginning of the video. The 3-candle model is considered the most common approach to defining CRT in this model. The first candle forms a range. The second candle creates a turtle soup by manipulating the price, and the third candle breaks through the range. But the CRT pattern is not always restricted to 3 candles, and multiple candles can form within the range. In this CRT model, the first candle is considered the range. However, unlike the 3-candle pattern, multiple candlesticks form before hitting or breaking through this range. This model takes longer to develop and is a more suitable method for obtaining confirmation before entering a trade. However, what is evident in both 3-candle patterns and multi-candle patterns is that the 3 main components, range, manipulation, and direction, are always present. This is what distinguishes the CRT range from a typical range. For this reason, there's always the possibility that a new CRT pattern may emerge within another CRT model. So, within the range, it's possible to enter a trade multiple times. But how should we trade CRT models? The CRT model can be combined with various trading concepts. However, the combination of turtle soup and AMD is considered the best rating method for the candle range theory. In trade, the term AMD, or power of 3, focuses on 3 phases of market behavior: accumulation, manipulation, and distribution. The accumulation phase occurs when the market is range-bound, typically with low volatility and minimal price movement. It is period traders begin accumulating positions in anticipation of a significant move during this phase. Traders may notice small candlesticks and low volume, which indicate that no major market move has yet started following accumulation. The market may create false breakouts, where the price moves sharply outside the established range to trap retail traders. This phase involves triggering stop-loss orders, commonly known as stop hunting. The goal here for smart money is to create liquidity by deceiving traders into entering premature trades before reversing the price back to its intended direction after the manipulation phase. The market moves decisively in the intended direction. This phase shows increased momentum with larger candlesticks and higher trading volume. It is during the distribution phase that smart money capitalizes on their earlier positions by driving the prices in the expected direction and profiting from the market's movement. By analyzing the chart, we observe that the 3 stages of accumulation, manipulation, and distribution repeat in a continuous cycle. The most critical stage is manipulation, as it often leads to the formation of a turtle soup pattern. A turtle soup pattern occurs when the price breaks through a prior, higher low, leading many traders to expect the price to continue in that direction. This breakout typically happens with a large candle or wick. However, instead of following through, the breakout fails and the price reverses, catching those who traded the breakout off guard. Order block and fair value gap that form after turtle soup pattern are considered entry area during distribution phase. We mentioned that candles are ranges, and time in the market is fractal. For this reason, each individual candle can be considered as representing accumulation, manipulation, or distribution on its own. Therefore, to determine the entry point, it is necessary to first identify the CRT model on a higher time frame, and then find the appropriate entry zone on a lower time frame. When the CRT model is formed on the monthly time frame, we use the daily time frame to identify the entry area. For the daily time frame, we refer to the 1-hour chart for the 4-hour model, the 15-minute chart, the 1-hour time frame, 5-minute chart. In the chart, a 3-candle CRT pattern is forming on the daily time frame. The first candle created a range marking the accumulation phase. The second candle broke through the range, forming a turtle soup pattern and sweeping liquidity, which indicated the manipulation phase on the 1-hour chart. We can observe that the market manipulated the range with a quick move leading to a market structure shift within the 1-hour time frame. After the manipulation phase, we should expect the market to enter the distribution phase. Therefore, the fair value gap formed after the turtle soup pattern and market structure shift can be considered a suitable entry point. We place our stop loss below the turtle soup area and set the top of the range as our take profit target. In our trades, we can consider areas outside the range, such as key support or resistance levels, as our take profit targets, and enter the trade with a higher risk to reward ratio. The CRT pattern may form with several candles within it. The chart in front of you highlights several important points. First, to identify the accumulation phase. It is not always necessary to rely solely on a single range candle. In the higher time frame, buy or sell orders may have triggered the formation of an accumulation phase several hours or minutes earlier. Equal highs and lows can be the most significant factors in identifying this phase. Second, the most important area for us is the manipulation phase, which sweeps liquidity, forms a turtle soup, and changes market structure after this as the price returns to the order block or fair value gap. We can enter a trade on the 4-hour chart range candle and the following candle due to its wick cause manipulation and the formation of a turtle soup pattern. Now on the 15 minutes time frame, after identical highs and lows, the price is broken through the resistance. The range area potentially, this re-entry has stop losses of both buyers and sellers. As a result, both the accumulation and manipulation phases are complete. A fair value gap or a suitable order block could now serve as our entry area. The top of the manipulation candle will act as the stop loss, and the take profit will be positioned outside the range area. After opening a position, we wait for the distribution phase to begin, which may occur after several candles. Hope this video has been helpful to you. Please like and subscribe to our channel.